Imagine walking into your bank, smiling at the teller and thinking, yeah, my money's safe here. That's the whole deal, right? You deposit your hard-earned cash and they take care of the rest. But here's the ugly truth. That illusion of safety, the blind trust we've placed in banks, has been one of the biggest enablers of financial scandals in modern history. And the story of how banks became these untouchable entities starts long before the headlines about LIBOR or toxic loans. Let's rewind a bit. Banks were originally built around one idea: trust. You give them your money because you believe they'll keep it safe and maybe even pay you a little extra as interest. Sounds good. Over time, that trust turned into dependency. Governments started backing banks with guarantees. Insurance systems were created, and suddenly, people stopped questioning how the whole machinery worked. Because why would you? The logos were shiny, the branches were everywhere, and the suits behind the desks spoke a language that made them sound smarter than the rest of us. Now, here comes the kicker. Banks realized that trust wasn't just public goodwill, it was a product, something to monetize, to leverage, and to weaponize. When people believe you're too big to fail, you can take risks they'd never dream of. You can move billions between countries, invest in derivatives that no one really understands, and still convince the everyday saver that everything's fine. That's how the modern banking world was built, on confidence, not transparency. But let's pause for a second. Have you ever thought about where your money actually goes once you deposit it? It doesn't sit in a vault waiting for you to come back. Banks lend it out, invest it, and sometimes even speculate with it. They do all this under the argument that keeps the economy running: credit for homes, loans for businesses, money flowing through the veins of finance. And to be fair, that's true. But there's a thin line between financing growth and fueling greed, and banks crossed it long ago. The transformation happened slowly, almost invisibly. As financial markets grew more complex, so did the institutions running them. New financial products appeared: derivatives, swaps, credit default obligations, fancy names for bets on other bets. At first, nobody outside the financial world cared. After all, if the system was profitable and the economy was growing, what could go wrong? Well, as history would prove again and again, plenty. Think of it like this. Imagine you're playing poker, but the dealer controls the cards, the chips, and the rules. That's modern banking in a nutshell. There was no longer a clear separation between the player and the referee. When investment banks started merging with retail banks, the kind that held your savings, the game changed forever. Suddenly, your paycheck was part of the high-stakes casino on Wall Street. This blending of worlds meant that risks, once confined to trading floors and investment funds, began to seep into the savings of ordinary people. The financial crisis of 2008 was the first massive wake-up call. Mortgage-backed securities collapsed, banks froze, and suddenly the same institutions that claimed to manage risk were begging for taxpayer bailouts. And do you know what saved them? That same trust. Governments couldn't let them fall because people believed too deeply in the system's stability. It's ironic, isn't it? The very myth that made banks powerful, that they were safe, forced governments to rescue them when they failed. And here's where the illusion becomes dangerous. Because when you know someone will always bail you out, what's to stop you from pushing the limits again? That's known as moral hazard, and it's a perfect description of post-crisis banking. So, how did we get to the point where banks became untouchable? Part of it comes down to sheer complexity. Financial products grew so intricate that even regulators couldn't fully grasp the risks. The average citizen had no chance. When you can barely understand your own mortgage terms, you're not about to question how global interest rates are set, right? And that's exactly how banks liked it. Layers and layers of jargon shielding them from accountability. Another part of it is branding. Step into any big bank branch and look around. The marble floors, the quiet background music, the polite smiles. It's theater. It's designed to make you believe you're in the safest place on earth. Behind that calm facade, though, lie algorithms, offshore accounts, and a tangled web of incentives that sometimes value quarterly profits over human lives. It's not personal. It's just business, as they say. But the facade cracked whenever scandals broke. From money laundering to rate fixing, it became clear that banks weren't just passive spectators of the global economy. They were the players, the referees, and sometimes the scriptwriters. The LIBOR case, which we'll dive into in the next chapter, was perhaps the most shocking example. For years, banks manipulated the world's benchmark interest rate, the rate that determined how much people paid for mortgages and loans, just to make a few traders richer. Still, every time a new scandal hit, something strange happened. People got angry for a while, regulators imposed fines, and then life went on. Banks paid billions, but barely flinched. Why? Because for every scandal, the trust cycle restarted. As long as you could log into your account, withdraw your cash, or swipe your card without an error, everything felt fine. People moved on, thinking the bad apples were gone, when the truth was that the orchard itself was rotten. There's another illusion at play here, the idea that banks serve the public good. It's not totally wrong, but it's incomplete. Their main duty is to their shareholders, not their customers. When a banker smiles at you across the desk, they might be compensated based on how much of your money they can turn into products, stocks, funds, insurances, or loans. So when they say, "This investment is perfect for you," what they often mean is, "This investment is perfect for my bonus." Now, let's get a bit more technical without getting too nerdy, okay? Banks operate under what's called a fractional reserve system. That means they only keep a fraction of deposits as actual cash and lend the rest out. It's efficient, but also risky. If everyone withdrew their money at the same time, the illusion would collapse. That's literally what a bank run is. So, for this system to work, people have to believe, no, they have to be sure, that the bank is trustworthy. Without that belief, the whole thing crashes. Governments and central banks understood this perfectly. That's why they back banks with insurance systems, like deposit guarantees, and step in during crises with bailouts. But those protections, designed to maintain public confidence, ended up reinforcing the illusion, because no matter how big the mistake, the banks always survived. The public message became, "Don't worry, we've got your back," and that made people complacent. Meanwhile, a new breed of banks, massive global institutions, turned trust into a business model. The bigger they got, the safer people believed they were. But as it turns out, bigness is not safety. It's fragility disguised as strength. Imagine a skyscraper so tall that one crack at the base can bring everything down. That's what too big to fail really means. Power concentrated in fragile balance. Let's be honest though, distrust alone isn't the answer. A healthy economy still needs banks. They're the plumbing of capitalism, keeping money flowing. The issue is transparency and accountability. And for decades, both have been sacrificed in the name of short-term gains. Bankers became rock stars, governments turned into spectators, and customers, well, most of them never realized that they were part of the performance. If you're wondering how it all connects, think of trust as the currency behind all money. Dollars, euros, yen. They're just paper or digits without confidence backing them. The same principle applies to banks. The second people stop believing, the value collapses. That's why institutions spend billions maintaining appearances, marketing campaigns, sponsorships, research reports, all to keep the illusion alive. And here's where things get really twisted. Once trust becomes a marketing strategy, it loses its meaning. When banks talk about ethics or sustainability now, it's often another product category. green bonds, ethical funds. So, next time you pass by a billboard promising, "We care about your future," maybe pause for a second. Ask yourself what that really means. Because in finance, words are cheap, but consequences aren't. The problem isn't that all bankers are villains, far from it, but that the system rewards behavior most of us would consider unacceptable anywhere else. When quarterly profits outweigh long-term stability, the cycle of deception keeps spinning. Throughout history, money and morality have never been comfortable roommates. Yet modern banking turned that awkward marriage into a global empire. Banks became the gatekeepers of opportunity. Want a house? Start a business. Travel abroad? You'll need them. That dependency gives them a leverage few other institutions enjoy. Governments regulate them, but they also rely on them to finance their debt. It's a complicated love story with no easy ending. Before we wrap this up, think of trust not as something given, but something earned and re-earned. When a bank loses it, the repercussions go far beyond one building or balance sheet. It shakes the foundation of societies that depend on stability. And that's why the next part of this story, the LIBOR scandal, matters so much. Because it wasn't just about numbers or markets, it was a betrayal of that fundamental belief that the system plays fair. So buckle up. In the next chapter, we'll dive into how a handful of traders managed to manipulate the pulse of the global economy, the LIBOR rate, and how their greed echoed in your loan payments, your mortgage, and even your country's debt. Because when banks lie, the ripple hits every single one of us, and understanding that lie is the first step to never falling for it again. All right, imagine this. You're sitting at your kitchen table, trying to make sense of your mortgage payments. The interest rate moves a little, your monthly bill changes, and you think it's because of some mysterious global market thing. Well, you're right. But what if I told you that for years, those movements weren't just market forces? They were manipulated, crafted, and twisted by the very bankers who were supposed to be impartial referees of the financial game. Before jumping into the horror show, let's get one thing clear. What is LIBOR, and why should you care? LIBOR stands for London Interbank Offered Rate. It was basically the interest rate that major banks charged each other for short-term loans, the foundation upon which trillions in loans, derivatives, and mortgages were built. Think of it as the heartbeat of global finance. When LIBOR went up, everything from student loans to business credit lines got more expensive. When it went down, borrowing got cheaper. Simple idea, massive consequences. Here's how it was supposed to work. Every morning, a group of the world's biggest banks would submit the rates at which they believed they could borrow money from one another. These submissions were averaged, a few outliers tossed out. And voila! You had the official LIBOR for that day. It was meant to reflect the true cost of money, pure and simple. But as it turns out, the process relied almost entirely on honesty. No oversight, no audits, just trust. And as we learned in the last chapter, trust in the hands of profit seekers can turn into a weapon. Now imagine that the people submitting these numbers realized something powerful. By nudging those rates a little up or down, they could influence billions in profits. They could affect the value of complex derivatives, tweak their bank's balance sheet, and make their trading positions look better. And because LIBOR served as a benchmark for so many financial products, those tiny tweaks rippled across the global economy like a silent earthquake. This wasn't some minor backroom trick. It was systemic manipulation. Traders would send messages to their colleagues handling LIBOR submissions, whispering requests like, "Mate, could you keep it low today?" Or, "Push it up a bit, I need it for my trades." Simple lines of text, but behind them, billions were at play. The audacity was stunning. They acted like they were setting the thermostat of the global economy, one they controlled from their fancy London offices. Let's put some perspective on the scale. LIBOR influenced more than $300 trillion in financial contracts worldwide. That's more than the combined GDP of every nation on Earth several times over. When you think about your mortgage payment, your student loan, or your credit card rate, all of them, directly or indirectly, were affected by this number. So, when these bankers manipulated it, they weren't just playing with financial markets. They were playing with your life. You might be wondering how nobody noticed. Well, the truth is, LIBOR wasn't just obscure. It was almost invisible to ordinary people. It sat deep within the plumbing of the financial system, hidden under layers of terminology that made most eyes glaze over. For regulators, it was a box checked, an assumption of integrity. And for those inside the banks, it was an opportunity too good to pass up. No alarms, no headlines, just easy money, rolling in quietly. The origins of this setup date back to the 1980s. Back then, London was becoming the world's financial hub, and banks needed a standard way to price loans among themselves. The LIBOR rate emerged as that standard, flexible, simple, and globally accepted. The problem? It was designed for an era when the financial world was smaller, more personal, and supposedly built on gentlemanly ethics. Fast forward a few decades, and those gentlemen were replaced by aggressive traders armed with algorithms and greed. When the 2008 financial crisis hit, things started to crumble. Suddenly, the interbank market froze. Banks stopped trusting each other, yet the submissions for LIBOR kept coming in every day, as if nothing had happened. Curious, right? Some banks were reporting they could borrow cheaply while others couldn't get liquidity at any price. That inconsistency was the first crack in the facade, and regulators finally began to ask, are these rates real? What followed was one of the biggest investigations in the history of modern finance. Regulators from the United Kingdom, the United States, and beyond launched probes into how banks set their LIBOR submissions. What they found was staggering. Chat logs exposed collusion between traders across banks. One would write, "Hey, keep it low for me today. I owe you lunch." Another would reply, "Sure, got you." Billions of dollars shifted hands based on these casual, almost playful messages. Here's the twisted part. For years, those submissions were sent in without challenge, published daily, and used to price everything from corporate loans to derivatives. Banks were, in effect, writing their own grades and telling the world they were A+ students. And because everyone trusted the system, nobody bothered to check the homework. When the truth came out, it was chaos. Banks were fined billions. Barclays, UBS, Deutsche Bank, and others faced massive penalties. But again, much like in other crises, the institution survived, and in many cases, the individuals behind the manipulation quietly moved on. Some were banned, a few were prosecuted, but the real damage was psychological. People realized that even the most basic mechanisms of global finance could be gamed by insiders chasing bonuses. Now, let's make this personal for a second. Suppose you had a mortgage linked to LIBOR. Even a tiny change, say 1/10 of a percentage point, could alter your monthly payment. For a household already stretched thin, that difference could mean hundreds over a year. Multiply that across millions of borrowers, and you start to see the ripple effect. The LIBOR scandal wasn't abstract corruption. It was a slow, invisible tax on everyday people. One reason the manipulation went unchecked for so long was the sheer complexity of the system. Regulators and the public couldn't easily see the cause and effect. When everything is connected, from your car loan to a multinational's credit line, shifting one tiny variable is like changing gravity itself. A small nudge in London could make a factory in New York or a family in Madrid pay more the next month. The scandal also exposed a deeper sickness, an over-reliance on self-regulation. For decades, banks assured the world that they could police themselves, that professionalism and reputation were enough. LIBOR proved otherwise. When profits depend on perception, honesty becomes optional. And when everyone is doing it, wrongdoing starts to feel like routine. After the dust settled, authorities tried to fix the system. By the end of the 2010s, global reforms were introduced. The publication of LIBOR was moved under stricter oversight, with real transaction data replacing estimates. Some versions of the rate were phased out entirely. The hope was to replace the old system with benchmarks based on actual market trades, not subjective opinions. In theory, it made manipulation harder, though not impossible. But here's the catch. Reforming a system like LIBOR doesn't change the culture behind it. The incentives, the bonuses, the thrill of bending the rules, those remained. Banks paid fines like they paid rent. It became a cost of doing business, not a signal to change behavior. And because the consequences weren't existential, the lesson didn't stick. There's also the dirty secret that LIBOR wasn't the only rate that could be manipulated. Other benchmark rates, from foreign exchange to commodity indexes, showed similar vulnerabilities. The real issue wasn't technical, it was moral. When the system rewards profit over principle, corruption adapts faster than regulation can stop it. Now let's ask the question that really matters. Could it happen again? The honest answer is yes, though it might look different. Financial systems today rely on algorithms, new benchmarks like SOFR, and complex digital markets. But corruption often evolves with its environment. Human greed finds new tools, and unless oversight grows stronger, the same playbook will resurface. The methods change, the motives don't. It's worth reflecting on what the LIBOR scandal represents. It wasn't just greed. It was the dismantling of one of finance's core assumptions, objectivity. We assume numbers don't lie. Rates, indexes, data, they're supposed to be truth in numerical form. But LIBOR showed that even truth can be for sale when enough money is at stake. And once that happens, every number becomes suspect. What made it particularly infuriating was the arrogance. In public, banks spoke about restoring confidence, building integrity, and acting responsibly. Behind closed doors, they treated the world's financial pulse like a toy. Traders joked about manipulating the rates, sometimes literally laughing while discussing how much they'd made. That disconnect between words and actions cut deep, because people need to believe that someone, somewhere, is making sure the system is fair. So what's the takeaway for you? First, understand that the financial system isn't a distant galaxy. It affects your daily life. Every time you sign a loan, make a payment, or invest, you're tied to these vast networks of trust and manipulation. Knowing how they work and how they can fail doesn't make you paranoid. It makes you prepared. Second, don't assume that regulations automatically mean protection. They're tools, but only as good as the people holding them. You might feel like the LIBOR story is ancient history, a problem from a different era. But its legacy still echoes. The transition away from LIBOR to alternatives took years and cost billions. Entire banking infrastructures had to recalibrate. And even today, countless financial contracts still carry its DNA. The ghost of LIBOR haunts the global markets, a reminder of how one tiny number can hold the world hostage. In the end, the LIBOR lie is more than a case study in finance. It's a lesson in human. Give a small group too much power, hide their actions behind complexity, and watch what happens. Transparency isn't just a moral virtue, it's a survival mechanism. And until systems are built that prioritize accountability over appearance, the same games will keep being played, just with new names. So, when you hear about interest rates in the news, maybe think twice. They're not abstract figures. They're reflections of trust, incentives, and sometimes manipulation. And if you ever feel that the financial world seems rigged in favor of the powerful, well, the LIBOR scandal is proof that you're not imagining it. In the next chapter, we'll move from the grand scale of global markets to the more personal battlefield, how banks turned their sales desks into traps for ordinary savers. Because sometimes, the lie doesn't start in London. It starts right across the counter at your local branch. Picture this. You're sitting in your bank, and the friendly advisor across the desk slides a brochure toward you. It's glossy, full of charts upward and glowing promises. He says, "This is a safe investment with better returns than your savings account." You look at the smiling faces on the cover, the stable percentage printed in bold, and you think, finally, here's something smart to do with my money. That's how thousands of small investors across the world got trapped in what would later be called one of the most shameless financial betrayals of modern banking, the preferred shares scandal. Now, before we go any further, let's clear up what we're talking about. Preferred shares, or preference shares, are a kind of hybrid investment, part stock, part bond. To put it simply, they pay fixed dividends like bonds, but they don't give you real ownership or voting rights in the company. So, how did this product find its way into the portfolios of retirees, teachers, factory workers, and small business owners who just wanted stability? Because the banks sold it to them, aggressively. During the early 2000 era, especially after the financial crisis, many banks were desperate to raise capital without appearing weak. Instead of issuing regular shares, which would have diluted ownership, they created preferred shares that counted as regulatory capital but could be sold to retail customers under the illusion of safety. It was a brilliant business move and a moral disaster. Imagine you walk into a bank to renew your fixed deposit, but the advisor says, "You know, rates are terrible these days. We've got an alternative that gives you better yield, guaranteed income, and flexibility." They talk fast, sound confident, and sprinkle in just enough financial jargon to sound credible. You don't want to miss out, and you trust your bank, the same one that's been managing your money for years. So, you sign the papers. Congratulations, you just bought a complex financial product designed for institutional investors, not ordinary people like you. These products were often structured in ways even many bank employees didn't fully understand. Some were perpetual, meaning they had no maturity date. You could never get your principal back unless the bank decided to repurchase them. Others had clauses that allowed the bank to freeze payments under exceptional circumstances, which, funny enough, always seemed to happen when things got tough. The marketing glossed over these details. The pitch focused on the steady income, not the fine print that said you could lose everything. For the banks, it was a perfect setup. They raised money cheaply, boosted their balance sheets, and shifted risk from themselves to clients. For customers, though, it was financial quicksand. When the economic winds shifted and banks faced turbulence, many of these so-called safe investments were suddenly suspended or written down entirely. People who had put their life savings into these instruments watched them vanish in days, often with zero compensation. The betrayal wasn't that the products failed, it was that they were sold under false pretenses. The emotional damage was immense. Retirees who had trusted their lifelong bank found out the hard way that loyalty in finance works one way only. When they asked for explanations, they heard words like market volatility or extraordinary measures. But the truth was simpler. Their bank had played them. These people weren't reckless speculators. They were victims of a system that treated financial literacy like a weakness to exploit. And the worst part? The institutions often blamed them for not reading the fine print. Let's break down the psychology behind it, because it's important. Most people don't wake up thinking they'll outsmart the market. They just want a safe place to park their money. Banks understand this perfectly. They use branding, trust, and human warmth as tools of persuasion. The advisor sitting across from you isn't a villain. They're following a sales script, chasing targets, and earning commissions for every signature they collect. The culture inside those branches wasn't about protecting clients. It was about meeting sales quotas. Now, the clever part is how the whole thing was disguised as financial empowerment. Ads promised independence, stability, and even exclusivity. Owning preferred shares made you feel like part of a smarter, wealthier crowd. It targeted the ego as much as the wallet. And when customers started getting nervous, bank staff reassured them saying, "Don't worry, we own these ourselves." That single sentence, often untrue, made countless people lower their guard. The banks had found the perfect emotional formula. Trust plus status equals compliance. As the losses piled up, lawsuits began to appear. Thousands of clients across Europe and the United States discovered that the so-called preferred shares were practically worthless. Regulators stepped in late, some of them admitting they hadn't even realized how massive the problem was. It wasn't just one or two banks. It was an entire network of institutions using similar tactics. The scandal became a mirror showing what happens when public ignorance becomes private profit. At this point, you might be wondering, how was all this legal? Well, that's the genius of the system. Everything was disclosed. Technically, the information was buried in dense prospectuses written in legalese that no normal human could decipher. Think of it like hiding a time bomb in 1,000 pages of footnotes. The regulations were satisfied, the boxes ticked, and as long as the customer signed, the responsibility was theirs. The banks didn't need to deceive. They just needed you not to understand. This kind of financial engineering wasn't accidental. It was strategic. After the crisis, regulators demanded that banks strengthen their capital buffers. Basically, keep more funds ready in case of trouble. So, instead of going to big investment funds, banks turned to the public. They saw retail customers not as clients, but as untapped sources of capital. And because the average person trusts their banker more than a faceless trader, it worked like a charm. Let's put some human faces to this story. Imagine a retired couple who saved for decades, living modestly. They walked into their branch, smiled at the same advisor who'd helped them since their first mortgage, and walked out proud of their new investment. A few years later, they're sitting in that same branch, tears in their eyes, told that their savings are gone. Somewhere between those two meetings lies the darkest side of capitalism, when institutions build profit strategies on the ignorance of the very people they claim to serve. It wasn't just individuals who suffered. The scandal caused a massive erosion of faith in the financial system. Social trust takes decades to build and seconds to destroy. The idea that a bank would knowingly sell products unsuited for its clients shattered something fundamental in people's minds. It blurred the line between legitimate business and exploitation. And once trust breaks, rebuilding it becomes nearly impossible, no matter how many smiling ads you put on billboards. To make matters worse, the response from many banks was tone deaf. Instead of apologizing, they doubled down on compliance language. We disclosed all the risks. Clients were informed. Market conditions were unpredictable. Technically true statements, but morally empty. The fine print became a shield against accountability. And that's what made the whole affair so infuriating. Not just the greed, but the indifference. Over time, regulators imposed new rules on product transparency and risk disclosure. Advisors had to pass stricter suitability tests, and banks were forced to document how they assessed a client's risk profile. But by then, the damage was done. The victims had already lost their savings, and the banks had already collected their capital. In some countries, partial compensation funds were set up, but they barely scratched the surface. It was like putting a bandage on a bullet wound. From a broader perspective, the preferred shares scandal was a symptom of a deeper disease, the transformation of banking from a service industry into a sales machine. Advisors became marketers. Relationships turned into transactions. The word customer was quietly replaced by segment, and while the language changed, the moral compass didn't just shift, it vanished. The entire logic became one of extraction. How much can we sell, not how much can we help? Let's be clear though, the customers weren't naive. They were misled. The financial world built its complexity to ensure that ordinary people couldn't navigate it without guidance. That dependency guarantees control. Every time someone says, "You wouldn't understand," it's technical. That's power talking. It's how the financial elite keeps the rest of society one step behind. And as long as complexity pays, simplicity will always lose. You might be thinking that this all sounds eerily similar to what we see today with some crypto products, insurance-linked notes, or other modern instruments, and you'd be right. The game hasn't ended. It's just evolving. The names change, the packaging improves, but the core tactic, selling you what you don't fully understand, stays the same. Preferred shares were simply one chapter in a much longer playbook of financial deception. So, what's the lesson here for you? The first one is that safety doesn't come from branding or promises. It comes from understanding. If someone tells you an investment is risk-free, run, because the only guarantee in finance is that risk never disappears. It just changes shape. The second lesson is that trust must be earned every single day. Blind loyalty in banking is as dangerous as blind faith in politics. When money is involved, skepticism isn't cynicism, it's self-defense. As we close this chapter, take one thought with you. Ignorance in finance isn't neutral, it's profitable for someone else. The preferred shares scandal proved that knowledge gaps are markets waiting to be exploited. And unless you fill those gaps yourself, someone will fill them for you. And you won't like the price. In the next part of this story, we'll look at how these practices weren't mistakes, but built into the DNA of corporate culture, the conflicts of interest that turned financial advice into one of the biggest sales games on earth. Let's start with a simple question. When your banker tells you, this product is perfect for you, who are they really working for, you or the bank? Most people assume that financial advice is just that, advice. You expect that the person sitting across from you is an expert with your best interests at heart. But in the modern banking system, that belief couldn't be further from reality. Over the past few decades, the line between advisor and salesman has blurred beyond recognition, and the result has been a quiet but devastating shift in how finance works. Picture this. A customer walks into a branch seeking guidance on how to save for retirement. The banker smiles, listens attentively, and then offers an investment product supposedly tailored to the customer's needs. On paper, it all looks professional. A consultation, a recommendation, and a happy client leaving with confidence. But what's missing from that picture is disclosure. The banker was paid a bonus to sell that particular product, not to find the best one. The incentives were never aligned with the client's interests. They were aligned with the bank's quarterly targets. This is what economists call a conflict of interest. It happens when someone in a position of trust benefits more from your decision than you do. In finance, these conflicts are everywhere, from hidden commissions to performance-based pay schemes that reward sales volume instead of quality advice. It's like going to a doctor who gets a salary boost every time they prescribe a specific brand of medicine, regardless of whether it works for you. Only here, the side effects hit your finances, not your health. To understand how we got here, we need to remember that banks once were relationship-based institutions. Your family banker knew you, your business, and your goals. They earned loyalty through service. But as the financial world globalized, personal banking turned into corporate banking. Branches became outlets, clients became segments, and advisors became sales agents. The transformation was subtle but total. Instead of measuring success by customer satisfaction, banks began tracking performance by product penetration and conversion rates. The pressure to sell transformed the very culture of banking. Employees at every level were given sales quotas that pushed them to prioritize volume over ethics. Promotions, bonuses, even job security depended on hitting those numbers. In some countries, internal memos openly referred to customers as targets. The profession that once revolved around stewardship turned into a numbers game where trust was traded for revenue. And unsurprisingly, this system bred manipulation. One of the biggest lies sold to the public was the illusion of independent financial advice. Banks wrapped their products in glossy reports, market outlooks, and expert language to make it all sound objective. But under the surface, the supposed advice was marketing, designed to channel client money into the most profitable instruments for the institution. It's a bit like a restaurant waiter suggesting the chef's special, not because it's the best dish, but because it's the one with the highest markup. Some of these sales tactics were shockingly aggressive. Advisors would call clients to warn them about limited-time offers, implying that opportunities would vanish if they didn't act fast. Fear and urgency became tools of persuasion. If a client hesitated, the advisor often reframed the hesitation as a mistake. "You don't want your money just sitting there, right?" This wasn't consultation. It was psychological manipulation disguised as professional care. And in many cases, customers didn't realize until years later that the advice they trusted was fundamentally biased. Behind this behavior lay a toxic incentive system. Banks created internal competitions. Who could sell the most credit cards, the most insurance-linked products, the most loans? Employees who didn't perform risked losing bonuses or even their jobs. Those who excelled were rewarded with trips, recognition, and career advancement. When you turn advice into a sales contest, ethics stop being part of the equation. It wasn't that every banker was dishonest, but the structure itself rewarded the wrong kind of honesty. Let's talk numbers for a second. In words, of course. Imagine a bank sells a complex mutual fund to a customer. The client thinks they're paying minimal fees. In reality, hidden layers of commissions, 1% here, another 0.5% there, add up over time, eroding returns. The bank profits, the advisor earns a bonus, and the client's retirement shrinks silently. Multiply that across millions of customers, and you get a financial machine designed to siphon value rather than create it. Independent financial advisors weren't immune either. Many worked under dual hats, claiming independence while being paid retroactively by the very firms whose products they recommended. The term for this is retrocession, a nice-sounding word for kickback. Even when regulators tried to curb it by demanding transparency, disclosures were often buried in fine print no one read or understood. Once again, technical compliance masked moral failure. So when people say, "Banks exploit ignorance," this is exactly what they mean. Financial institutions depend on asymmetry. They know more, you know less, and that gap is profitable. The complex jargon, the endless product categories, the beautiful graphs in brochures, all reinforce dependency. And dependency breeds control. The customer believes they're making informed decisions, but in reality, they're being nudged, shaped, and guided toward what benefits the bank most. Now you might wonder, shouldn't regulators prevent this? In theory, yes. In practice, regulators often arrive after the damage is done. Financial rules evolve slower than financial tricks. By the time a new disclosure law or transparency rule appears, the industry has already invented 5 new ways to bypass it. It's a cat-and-mouse game, except here, the mouse writes the rules of the game. And because bankers sit on advisory boards of regulators, conflicts of interest extend even to the watchdogs. The scandals of the 2010s, from missold insurance to bundled credit products, exposed how deep the rot went. Internal investigations revealed that some employees were pressured to open fake accounts, alter risk profiles, or falsify signatures just to hit quotas. These weren't isolated incidents. They were symptoms of a larger sickness, a systemic prioritization of profit over integrity. It wasn't about bad apples. It was about a poisoned orchard. If all of this sounds cynical, it's because it is. But it also explains why financial literacy is becoming one of the most critical tools of empowerment today. Once you understand the incentive structures behind advice, you stop taking recommendations at face value. You start asking, how does this person get paid? What's in it for them? Those simple questions can change your entire financial trajectory. Because in modern finance, transparency isn't given. You have to demand it. Of course, not every advisor is corrupt, and not every bank operates without conscience. There are professionals who genuinely care about helping people grow their wealth responsibly, but even they struggle inside systems built for sales. Imagine being a banker who wants to do the right thing, but knows your paycheck depends on pushing certain products. The moral friction becomes exhausting. Over time, many either conform or leave the industry altogether. And when integrity exits stage left, only salesmanship remains. What makes this phenomenon particularly dangerous is its subtlety. People rarely realize they've been sold, not advised, until years later. By then, it's too late. The product has matured, the returns never matched expectations, and the advisor who sold it has moved on. Banks rely on short-term memories and revolving staff to ensure accountability never sticks. It's a system designed to forget as much as it sells. The irony, of course, is that much of this could be avoided if advisors were paid for results that genuinely benefited clients. Some countries have experimented with fee-only models, where advisors charge transparently for their time, not commissions. It's a cleaner setup, but it hasn't dominated, because the traditional model still delivers bigger profits for banks. As long as investors remain complacent, the incentive to change stays weak. So what can you, as a consumer, do? First, understand that when you walk into a financial institution, you're entering a marketplace, not a counseling session. Every word, brochure, and recommendation you hear is likely tied to a target. That doesn't mean reject everything. It just means ask the tough questions. Who benefits if I buy this? What are the real costs over time? And most importantly, what happens if things go wrong? If the answer sounds vague, walk away. Second, diversify not just your investments, but your sources of information. Learn from books, articles, and independent specialists who aren't bound by corporate scripts. In a world where financial complexity is sold as sophistication, knowledge becomes your shield. The more you understand, the harder it becomes for anyone to exploit you. Ignorance might be bliss in some areas of life, but in finance, it's expensive. And finally, remember that trust in finance, once broken, takes generations to rebuild. Every time an advisor betrays a client's confidence for a commission, the entire industry loses a little more credibility. That's why transparency is not a marketing slogan, it's survival. The next stage of banking will depend on whether institutions can shift from extraction to genuine partnership. Whether they can remember that client service once meant service, not sales. As we move forward in this story, the picture becomes clearer. From manipulated interest rates to predatory sales tactics, one theme repeats. The system works beautifully for those who designed it, and brutally for those who don't understand it. The good news? Knowledge can flip that equation. But first, we need to confront the consequences of these practices. The public outrage, the billion-dollar fines, and the so-called reforms that claimed to fix everything but barely scratched the surface. That's where we're headed next. By now, you've probably started to see the pattern. Every financial scandal seems to end the same way. The headlines explode, people get angry, politicians call for justice, and within months, the fury cools off. Then, somewhere behind closed doors, deals are made, fines are paid, and the world quietly moves on. The banking giants stand tall, slightly bruised, but far from broken. This is the reckoning, but not the kind you might imagine. It's a ritual: public outrage, corporate apology, regulatory paperwork, and then business as usual. Let's rewind to the aftermath of the LIBOR scandal we discussed earlier. Between the years 2012 and 2015, global banks paid billions in penalties. The sums were enormous on paper, hundreds of millions here, a couple of billion there. It sounded like justice, but if you compare those fines to their annual profits, the story changes. They were fines that didn't hurt. They were parking tickets for institutions that had made fortunes manipulating the system. Consider this. When penalties represent a rounding error on a quarterly report, they stop being deterrents. They become expenses, costs of doing business. For every scandal, there's a legal department ready to calculate the potential damage and weigh it against the profits made from breaking the rules. If the math works, the decision is easy. Ethics lose to economics every time. And that's precisely what happened after the great financial scandals of the 21st century. Governments proudly announced reforms. The United Kingdom created new oversight agencies. The United States introduced laws like Dodd-Frank, and Europe promised stricter transparency requirements. On paper, the world had learned its lesson. But here's the uncomfortable truth. Regulation often makes systems more complicated, not clearer. Layers of bureaucracy pile on top of one another until nobody really knows who's accountable. Complexity becomes camouflage. Banks, as always, adapted quickly. Their lawyers found loopholes faster than regulators could close them. Entire teams were dedicated to compliance innovation, which is a fancy way of saying creative rule bending. Meanwhile, lobbyists swarmed capitals, arguing that stricter rules would harm economic growth. The result? Softer reforms, longer deadlines, and ever more flexible language. In the end, the same institutions that had caused global chaos were practically designing the rules meant to restrain them. Let's talk about perception, because that's where most of the reform energy went. Public confidence had to be restored, not necessarily through deep change, but through appearance. Banks launched campaigns about transparency, customer focus, and bringing banking back to trust. New logos, new slogans, fresh coats of credibility. But under those marketing layers, incentive structures barely shifted. The same bonuses, pressures, and targets remained. The playbook didn't change, only the cover did. It's ironic. The very word reform suggests moving forward. But much of what happened after these scandals was about preserving power. Governments couldn't afford for major banks to fail. They were too entangled with national economies, pension systems, and corporate credit. So, instead of radical accountability, we got managed stability. A few executives resigned, a few reputations burned, but the institutions survived intact. The public narrative was one of punishment. The private reality was one of survival. And somehow, despite everything, trust returned. That might be the most surreal part. Within a few years, savers and investors were once again putting their faith and money in the same institutions that had deceived them. Humans have short memories, especially when convenience is involved. Online banking, new apps, and smoother digital experiences created a sense that things were different now. Spoiler alert, they weren't. The facade had simply gone digital. When you look closely, you notice that most of the so-called accountability landed on individuals with limited power. Traders, middle managers, or small teams became scapegoats. Meanwhile, senior executives claimed ignorance, insisting they couldn't possibly have known the details. And legally, it worked. Finance is structured in such a way that responsibilities are shared, diluted, and spread across departments until they disappear in a fog of bureaucracy. In simpler terms, no one was truly held accountable. Regulators faced their own contradictions. They needed to appear tough, but not too tough, because markets don't like drama. A harsh stance might cause stock prices to crash, pension funds to shrink, or political pressure to rise. So, regulators became performers in a delicate balancing act, waving the stick without ever striking too hard. As long as markets stayed calm, public fury could be managed through statements, hearings, and symbolic reforms. Meanwhile, the people who suffered the most, ordinary investors and small savers, rarely saw justice. Some received partial compensation funds that reimbursed a fraction of their losses. Others fought long legal battles that drained what little they had left. For them, the reckoning was personal and devastating. For the banks, it was procedural, an entry on the balance sheet labeled Litigation costs. That contrast says everything about how uneven the system truly is. And here's the kicker. Despite all the chaos, banks grew bigger. Mergers and acquisitions during the post-crisis years created financial giants even more concentrated and powerful than before. The logic was that bigger meant safer, because governments could monitor fewer entities. In practice, it meant fewer competitors and more systemic risk. Imagine a game of Jenga where the blocks keep getting taller and heavier. You don't make it more stable by stacking higher. You might think at this point, surely lessons were learned. To some extent, yes. Banks did invest in risk management and compliance tools. They hired armies of consultants and lawyers to ensure no one could accuse them of negligence again. But at its core, the culture didn't shift. It evolved. Self-interest became smarter, more data-driven, and harder to detect. Instead of bold fraud, we got subtle manipulation hiding behind algorithms and automated decision-making. Financial reform, in theory, should protect the public. In practice, it often protects the system. Central banks guaranteed liquidity to prevent chaos, which made sense, until those guarantees became permanent. Low interest rates flooded the market with cheap money, encouraging risk-taking and speculation. The moral hazard we talked about earlier came roaring back. Once again, profit was privatized and risk was socialized. But let's be fair, wiping out an entire financial system isn't realistic. The global economy depends on functioning banks. Without credit, industries collapse, payrolls freeze, and governments themselves falter. So policymakers face a grim choice. Punish the culprits severely and risk instability, or stabilize the system and let misconduct go largely unpunished. Throughout history, they've consistently chosen the latter. Stability always trumps justice. However, that choice comes with consequences. Every time a bank escapes real accountability, a dangerous precedent is set. Future bankers watch closely, realizing that the downside of misbehavior is temporary embarrassment, not existential ruin. The message becomes clear. Push the limits. The system will protect you. And that, more than any policy failure, is why financial scandals keep repeating. Without fear, there's no restraint. Here's something few people talk about. Reforms often create false security. When new laws hit, people assume the problem's solved. Confidence rises, oversight relaxes, and new loopholes begin to form. Regulation, in a way, becomes cyclical, a back-and-forth dance between crackdown and complacency. The banks know this rhythm well. They adapt, they wait, and when no one's watching, they innovate in the gray zones again. It's a perfect ecosystem for controlled chaos. Still, not everything is doom and gloom. There have been genuine attempts to shift toward ethical finance, sustainable investing, social banking, and more customer-centric models. These efforts, while small in scale, show that change isn't impossible. There are financial institutions trying to rebuild credibility from the ground up, but as long as the largest players dominate the narrative, these ethical alternatives remain on the sidelines, fighting an uphill battle for public attention. You might ask, why doesn't public anger drive stronger reform? The answer lies in complexity fatigue. When something is too technical, too vast, or too slow, people tune out. Banking scandals are the perfect example. They're complicated, abstract, and emotionally distant until your own finances are affected. By the time you grasp the wrongdoing, the system has already patched itself with a new logo and a marketing campaign about renewal. It's psychological judo, using your apathy against you. In the end, the most profound lesson of the post-crisis years may be this: the greatest power banks hold isn't their capital, but their ability to redefine trust. They understand that people don't demand perfection. They demand reassurance. As long as the ATM works, the app loads, and the card swipes, the illusion of stability survives. That's the silent contract between banks and society. You pretend to believe, and they pretend to behave. Does that mean all hope is lost? Not at all. But it does mean any meaningful change must start from awareness, not outrage. Outrage fades. Awareness persists. The public needs to evolve faster than the institutions. That's where education, transparency, and digital empowerment come in. If you understand the incentives, if you know the history, then you can recognize when the same mistakes start resurfacing, because they will. As we approach the final chapter, we'll switch gears from outrage to action. You've seen how manipulation and moral hazard dominate the system, but now it's time to look at what you can actually do about it. Not to dismantle banks, that's unrealistic, but to protect yourself from their tricks. Because the more informed you are, the harder it becomes for anyone, no matter how powerful, to profit from your trust. That's where this story turns practical. All right, let's get practical. You've seen how the system works, how trust, complexity, and greed fuse into a cocktail that can drain your savings faster than you can say financial innovation. But here's the thing, you don't need to be a victim. Knowledge is your best armor. And understanding how toxic products are built and sold is the first step to protecting yourself. This isn't about paranoia, it's about awareness. So, let's build your personal checklist for spotting trouble before it hits your wallet. First, the golden rule. If something sounds too good to be true, it is. Every financial scam in history has started with that same seductive promise. Higher returns, lower risk, total safety. Banks and brokers know exactly how to play to human desires for security and gain. That's why they use comforting words like guaranteed, fixed income, or sheltered. But money doesn't grow risk-free, ever. When someone claims it does, you're not looking at an opportunity. You're looking at bait. Let's break that down with simple logic. Imagine two investments. One offers moderate returns with clear risks. The other promises double the gain without volatility. Which one feels more appealing? Of course, the second. But that's precisely how manipulation works, by appealing to emotion rather than reasoning. They sell you the dream first, then bury the danger in fine print. If a product relies more on feelings than facts, that's your first red flag. The second rule, always ask how they make money. Sounds basic, but you'd be shocked how many people skip this. Financial products are designed to generate profit, not just for you, but for whoever sells them. If you can't clearly see who benefits and how, something's off. It might be hidden commissions, performance fees, or opaque structures that ensure the institution wins regardless of outcome. Transparency is honesty. Vagueness is camouflage. The third rule, never let complexity intimidate you. Toxic products thrive on confusion. The more complicated the explanation, the easier it is to hide risk. You'll often hear phrases like structured note, capital-linked product, or hybrid instrument. These sound sophisticated, but they usually combine high risk with low transparency. Ask questions until you understand. And if the person explaining it gets impatient, condescending, or evasive, congratulations, you've just confirmed there's something they don't want you to know. Here's a quick exercise. Next time you're pitched an investment, ask yourself 3 questions. First, do I fully understand how this works? Second, what is the worst-case scenario if the market crashes or the bank fails? And third, how easily can I get my money back if things go wrong? If you can't answer all 3 without hesitation, step back. Financial safety doesn't come from complex strategies. It comes from clarity and control. Fourth rule, beware of urgency. Sales tactics often depend on pressure. Limited time offer. Exclusive deal. Rates changing soon. These are classic persuasion games designed to short-circuit your reasoning. They make you act fast before doubt can catch up. In finance, legitimate opportunities don't vanish overnight. If someone's rushing you, it's not because they care about your future. It's because they care about their bonus. Good decisions require time. Bad ones insist on speed. Now let's talk about language, because words can be weapons. Toxic financial products often hide behind friendly, misleading labels. For instance, the term preferred in preferred shares sounds reassuring, doesn't it? As though you're part of an elite, prioritized group. In reality, it means you're preferred only when the institution's doing well. When it collapses, you're the last in line. Always decode marketing language. Whenever you see comforting adjectives, replace them mentally with, check the fine print. Fifth rule: don't confuse reputation with reliability. Many people assume that big names can't fail or cheat. The larger the bank, the safer the product, right? Wrong. The LIBOR scandal alone should have cured us of that illusion. Trust should never be automatic. It should be earned and verified. A well-known brand might make you feel safe, but feeling safe and being safe are two very different things. Remember, size protects the institution, not necessarily you. Next, understand the risk-return equation. This is one of the most fundamental principles in finance. Higher returns always come with higher risk, always. If someone tries to sell you a product with high returns and minimal exposure, challenge it. Ask for documented proof of what that risk is. And don't settle for vague answers like market fluctuations or rare circumstances. If they can't quantify risk, they haven't measured it, and that means you're the one taking it unknowingly. Here's another rule: diversification. It sounds boring, but it's the closest thing to a superpower that everyday investors have. Never let any single product or institution control all your wealth. Spread it across different asset types, sectors, and countries if possible. Diversification doesn't guarantee against loss, but it prevents total disaster. A toxic product might knock down one wall, but it won't collapse the entire house if you've built it with multiple materials. And let's not forget the emotional traps. Financial salespeople are trained to read you. Your fears, your hopes, your hesitation. They might complement your intelligence, appeal to your sense of responsibility, or remind you that smart investors act, not wait. All psychological hooks designed to bypass logic. Anytime an advisor seems more interested in flattering than explaining, your mental alarm should go off. They're building rapport, not transparency. Another critical point: liquidity. Always ask how easily you can convert the investment back into cash. Many toxic products lock you in, often for years, and punish early exits with heavy penalties. You only realize how trapped you are when you need urgent access to your funds. Liquidity isn't about greed, it's about flexibility. In uncertain times, the ability to move your money can be the difference between recovery and ruin. Now let's touch on documentation, the tedious but essential part. Always read the terms yourself. Not the brochure, not the summary, but the actual document that spells out rights and conditions. If it's 100 pages long and written in legal jargon, guess what? That's not an accident. Complexity discourages reading, and unread contracts are fertile ground for exploitation. If someone tells you, it's standard, translate that as, there's something in there worth checking. The next item on your checklist is independence of advice. Whoever guides your decision should not be financially tied to your choice. If their paycheck depends on what you buy, their advice cannot be neutral. Full stop. Always ask how advisors are compensated. The more transparent their structure, the better. And when possible, consult more than one opinion. Cross-checking information is like getting a second medical diagnosis. It keeps you from falling into a single biased narrative. Let's address one of the trickiest issues, the allure of exclusivity. You know the pitch. This isn't available to everyone. We reserve this for preferred clients. Or, you've been selected for a private opportunity. That language activates ego and trust at the same time. Suddenly, you're not just a client. You're part of the inner circle. But scarcity is one of the oldest sales tricks in the book. If a product truly worked as promised, they wouldn't need secrecy to sell it. Financial self-defense also means understanding your goals. Before saying yes to anything, ask, what am I trying to achieve? And does this product genuinely help with that? If your goal is stability, don't let someone sell you speculation. If your goal is long-term growth, don't fall for quick returns. Matching the product to your purpose keeps you grounded. Otherwise, you'll end up chasing shiny distractions instead of real progress. Another sign of toxicity is when rewards are front-loaded, but risks are delayed. For example, promotional interest rates or early bonuses can make you forget that actual performance comes later. This is common not only in investments, but also in insurance and credit offers. They lure you with initial comfort, then tighten the noose with conditions. If the good part comes immediately and the bad part comes later, you're likely paying invisible costs somewhere in between. Let's talk about risk disclosure. Real advisors explain risk before profit. Sellers do the reverse. Always notice which part of the conversation comes first. If your advisor spends 10 minutes on potential returns and rushes through the risks in 30 seconds, that's a script, a sales pitch, not professional counseling. The order of conversation reveals the order of priorities. And finally, Rule 10. Keep learning. The financial world doesn't stop evolving, and neither should you. Banks, startups, and scammers all reinvent themselves constantly, so your defense must evolve too. Today's toxic product might not be preferred shares or fraudulent rate manipulation. It could be digital tokens, unregulated lending platforms, or new AI-powered investment tools. The names change, but the mechanism stays the same. Exploit what the public doesn't yet understand. Let's recap what we've built here. Your checklist isn't a magic shield, but a mindset. It's a way to approach finance with curiosity and caution instead of fear or greed. Every opportunity should face interrogation. Who profits, who risks, and who guarantees? When you demand clarity, you change the dynamic. The bank stops being your guardian and becomes your service provider, which is how it should have always been. Now, why does this matter? Because the next financial crisis might not come from Wall Street or London. It might come from the apps on your phone, the flashy fintech startups promising effortless wealth, or the influencer telling you to buy something safe and revolutionary. The game of deception has simply moved digital. And in a digital age, personal responsibility isn't optional. It's survival. So here's a final thought to leave you with. When banks, brokers, or platforms promise safety, ask for proof. When they promise profit, ask for risk. And when they talk about trust, ask what they've done to earn it. The power to protect your money doesn't come from regulations or reforms. It comes from knowing the game and choosing not to play it blindly. Because when you understand how the traps are built, you stop walking into them and start walking toward real financial independence.